Hello and welcome to a discussion on financial statements. In this session, we will try to see the interrelationship between the financial statements, income statement, balance sheet and cash flow statement. They are interdependent. So when we say a set of financial statements, the set of financial statement consists of opening balance sheet, income statement for the period, cash flow statement for the period, and closing balance sheet. But the changes in these two balance sheet, opening balance sheet and the closing balance sheet of a company, can be explained by the income statement and the cash flow statement. So it is possible to prepare a cash flow statement if the opening balance sheet, income statement and closing balance sheet are given. Similarly, if income statement, cash flow statement and closing balance sheet is given, then one can prepare the opening balance sheet. So the changes in a balance sheet on two dates reflects the business decisions, and the business decisions are captured in the income statement and cash flow statement. So let us see this financial statement. See, the balance sheet, opening balance sheet is given, closing balance sheet is given, income statement and cash flow statements are there. Let us pick up some items, okay, and observe whether the changes in the balance sheet are captured by the income statement and cash flow or not. Let's say retained profit. So the retained profit increase is reflected by the PAT which is shown in the income statement. No change in the bonds, no change in the creditor, but if you observe the debtors, so the debtors have changed, and the change in the debtors are visible in the income statement and the cash flow statement. So most of the items on the balance sheet and the changes in the balance sheet can be seen through the income statement and cash flow statement. For example, plant. The plant change is because of depreciation, which is there in the income statement. Take the case of stock. Stock change is because of income statement and the cash flow statement. So every item on the balance sheet, the changes in the items on the balance sheet can be observed through the income statement and the cash flow statement. Now therefore, if one of these items, one of these statements are missing, if the balance sheet is there, opening and closing, income statement is there, if cash flow is not there, we can prepare the cash flow statement because of the relationship between these financial statements. Let us take this example. So in this example, there is an opening balance sheet given, closing balance sheet given, income statement given. What is not given is a cash flow statement. But at the same time, unlike this, the transactions which are given here, the transactions given here, but the transactions are not given here. But even without the transactions, if the financial statements, three financial statements are there or are given, then it is possible to find the underlying business decisions as the process prepare the missing financial statement, which is the cash flow statement here. Cash flow statement can be prepared either from the balance sheet, we can pick up item by item and understand the change, or we can prepare by taking the income statement item by item. So let us pick up the sales. Income statement is prepared on the basis of accrual principle and matching principle. But cash flow statement is not prepared on the basis of accrual or matching. So you have to keep that in mind. Sales is an income, but for preparing the cash flow statement we need collection. And the collections from the customers can be determined by seeing the debtors and the sales. So let us say opening debtor is opening debtor is 25,000. Sales during the period, so add sales, and the sales during the period is 100,000. Sales during the period is 100,000 less collections will give us the closing debtors, because there is no bad debt or discount. So the closing debtor is 30,000. So that means the collection is 25,000 plus 100,000 minus 30,000. So 95,000 is the balancing figure which we treat as the collection missing item to be found for the cash flow statement. So collection can also be determined in another way. If you see sales, but is this sales for cash? We don't know. But if you see the credit debtors have gone up, so that means 5,000 goods have been sold on credit. So 100,000 minus the change in the debtor is also 95,000. But it's always better to have a framework for our calculation. So it's better to follow this process of finding the missing figure by understanding the relationship between the opening and closing items. Now let us pick up some other items. Next item is a dividend. Dividend is an income. But how will you know that the dividend has been received? We know that income received, okay? So whenever there is an income, so income received will be there, income received or income not received. If not received, that will be there in the balance sheet on the asset side, and if it is a receipt, is a cash inflow. So there is an income, but there is no asset for dividend. On the asset side, there is no dividend receivable. So therefore, entire dividend is received during the period. Take the case of, we'll come back to COGS a bit later. Salary. Salary is an expense. In the same manner, we can say that an expense paid or expense not paid. If not paid, it should appear on the balance sheet on a liability. If it is paid, then it will be a cash flow. So observe here, salary is 10,000, but on the liability side there is no outstanding salary. That means entire salary has been paid during the year, so that is a cash outflow. Let us take interest. Same explanation, no outstanding interest on the sources side, so entire interest paid. Same is the explanation for the tax. Entire tax has been paid because no outstanding tax or tax payable on the balance sheet on the sources side. So sales done, dividend done, salary done, interest done. Depreciation, if you see the change in a plant was 50, plant reduced to 45,000 because of depreciation, and depreciation is a non-cash, will not directly affect the cash flow statement. So depreciation done. Now what is left is a COGS. Cost of goods sold is related to stock and the creditor. So it is always better to understand the creditor and stock together. So creditor, opening creditor, let us first understand the relationship. Opening creditor, add purchases, less payments, because there is no discount or creditor or any loss, will give us the closing creditor. In the same way, opening stock, add purchases, less COGS, will give us the closing stock. So let's first find out the stock. Opening stock 30,000, closing stock is 20,000, cost of goods sold is 22,000. So the purchases, which is a missing number, purchases missing number is equal to 20 plus 22 minus 30 will give us the purchases. And this purchase, for the time being, we assume that is for credit purchases. So I transfer that to the creditor. So creditor, opening creditor was 10,000, closing creditor 3,500, and purchases is, we got it from here. So the balance is the money paid during the period. 10 plus 12 minus 3,500 is the amount paid to the creditor. So on the payment side, we can say payment to the creditor is 18,500. You can also, if you say that this is not a credit purchase, cash purchase, show entire 12,000 in the payment and the reduction in the creditor by 6,500 in the payment. So the amount is 18,500 in both ways. So as I mentioned here, it is always better to have a framework. So whenever there is a creditor, examine the relationship between the creditor and the stock, find the purchases, treat that as a credit purchase. If no information given, then calculate the creditor. Payment to the creditor. So that is also done. Now check all the items on the income statement is done. Then we'll see the capital. No change in the capital, so we assume no cash flows for capital. Reserves. Why did the reserves change? The reserves have increased from 80 to 95,000, but generally the reserves increase because of, so opening reserves, add profit, add PAT, less dividend is a closing reserves. So closing reserve 95,000, opening reserve 80,000, profit for the year 47,000. So that means the missing figure, balancing figure, is the payment of dividend. If you would not have paid the dividend, the reserves should have gone up by 80. The reserves should have been 80 plus 47,950. But the reserves are 95,000. So therefore, that is the payment of dividend. So the dividend payment is 32,950. So dividend is another missing figure. If you see reserves done, loan. What happened to the loan? Loan have reduced. That means the loan has been repaid during the year 5,000. But you can ask a question here. How will you know here how much, when was the loan repaid? To answer that question, observe the interest. You paid interest 2,500, which is for the entire year on 25,000. That means the loan has been used fully till the end of 2010 accounting year. So that means the loan has been repaid at the end of the year, not in the middle of the year. So that shows, if you observe the items keenly, you can also find out the date of the transaction. So if all the items are taken care, so cash inflow 60, 95 and 8, so summation of that will give you the cash available and cash outflows are 89,000. So cash in hand 163,000 minus 89,000 is 73,500. We can say this is the right answer because the cash in hand in the balance sheet is also 73,000. So observe, if these are not same, then the cash flow statement prepared, there are some errors. So you have to reconcile these two. But as we have done in the previous example, so let us also convert the receipts and payment into operations, financing and investment. Cash from operation 95,000 minus salary minus tax minus creditor will give us the cash from operation. Financing, cash from financing, no inflow, outflow, interest minus the dividend and minus the loan paid is a cash from financing 40,450. Investment, you receive the dividend minus no other payment, so therefore, and to check if whether we are right or wrong, summed up, so you'll get the cash in hand which is 73,500. So cash from operation 45,950, cash from financing negative 40,450, cash from investment positive 8,000. To continue our discussion on CFO, we can also find CFO by indirect method. Indirect method, adjust for depreciation, so add back depreciation. Adjust for non-operating, add back interest. Less dividend, because the dividend is a non-operating cash flow. Changes in a working capital. Changes in a working capital, what happened to the creditor? Creditor has reduced, that means you made the payment to them during this period. Debtors, that means you sold the goods on credit, so did not collect the cash, so minus 5,000. Stock reduced, that means the goods purchased in the last year, used in the current year, we did not pay money to the next end, so it's as good as cash because you have deducted the entire COGS in the current period. To sum this up, we'll get the cash from operation which is 45,950. So to summarize, when we say that opening balance sheet, income statement, closing balance sheet are given, it's possible to prepare the cash flow statement because the opening balance sheet, closing balance sheet, income statement and cash flow statement together is a complete set of financial statements which shows the transactions for the year and the impact of that on the opening balance sheet. So opening balance sheet plus minus the transaction will give us the closing balance sheet, which we have seen here. So the opening balance sheet, if you pick up any items here, just like we did in the last, so any items here will be adjustment as is due to the income statement and the cash flow statement. Thank you very much.